On Tuesday, Jamie Dimon, the CEO of JP Morgan Chase, warned that there are problems in the banking system when he said, when you see one cockroach, there are probably more. And what he was doing was signaling there are deep cracks in the financial system. And sure enough, the very next day, the bank swarmed the Fed's standing repo facility. They grabbed $6.75 billion in emergency cash. And my friends, this is the biggest non-quarter end spike since the COVID meltdown. And today, it escalated. They grabbed another $8.35 billion, proving this isn't a glitch. It's starting to become a frenzy. And this isn't a routine Fed plumbing issue. It's a screaming alarm that liquidity is evaporating faster than you think. And with banks massively short on dollars, they're trying to scramble to stay afloat. And we're starting to see early tremors of full-blown funding crisis. Banks won't be able to cover withdrawals or liquidations because their collateral is underwater. They can't sell it. They're upside down, and now they're trapped. And without any Fed long-term lows to save them, they're forced to go to the overnight facilities. Now, this dollar shortage I've been pounding the table on is starting to explode into view, and now we're seeing that this is going to force Fed Chair Powell to scramble. We're going to hear from him at the end of the month, but this means he's likely now to slam the brakes on quantitative tightening, and he's going to increase talks of a rate cut to avert an all-out banking disaster. But here's the shift you need. This chaos isn't the inevitable doom. It's your wake-up call. You've got a narrow window right now to shield yourself from the fallout. Stick with me, because in the next few minutes, I'm going to arm you with the exact blueprint to access your money, even if the banking system completely freezes up. And tonight's show is brought to you by Clean Core Solutions. And together with the House of Doge, you can find on the NASDAQ and the symbol TBH. They're the driving force behind Dogecoin's big leap into everyday payments and global deals that could skyrocket its real-world use. Now, stay tuned to the end of the show or check out the pinned comment or description for more information. Because right now we're on the verge of a funding crisis as Fed's emergency liquidity facility unexpectedly soars the most since COVID. Now, one thing I want to do here is dispel a myth, and you're going to hear a lot of this, that this problem is all about bank reserves and quantitative tightening. Because right now Fed reserves have fallen below $3 trillion, a view of which most officials say is a red line between, quote, abundant and scarce reserves. Now, for those unfamiliar, when bank reserves become scarce, and here's the myth, you get bank failures, repo markets go haywire, and generally the market crashes. But here's something most people don't realize, is prior to the global financial crisis, we didn't have bank reserves. There were none. There was absolutely zero in the system. And guess what? Everything worked just fine. Now, today, the Fed believes there's a minimum number of reserves needed, but there's absolutely no evidence to support this. Because what we're seeing here in real time is a dollar shortage that I've been worrying about. It's at the infancy, but it's on the verge of blowing up. Now, normally you see temporary spikes in the standing repo facility right before a quarter end when banks need extra cash. But that's not what's happening right now. This move is a warning of a dollar shortage as banks seek to grab cash in an increasing amount each day. So here's the way it works. If you're not familiar with how the facility works, banks take collaterals, think treasury bonds or even mortgage-backed securities, and they get an overnight loan for cash. Now, the problem is they needed $6.75 billion on Wednesday, and today they needed even more, $8.35 billion. It's a sign that the situation is not getting better. Even SOFR rates are rising, and this is an indication that the banks that do have money, they don't want it to lend it to those who are short. But I want you to understand, is this grab for cash? This is exactly what happens when lending contracts. You see liquidity dry up, delinquencies start to rise, and then it hits asset prices, including at some point it'll hit the stock market in a big way. And here's the proof. I want you to see this chart of commercial industrial lending versus the nominal broad dollar index, because what I want you to understand is that when banks are lending, that means they're creating money. But when lending goes into contraction, dollars are being destroyed. It doesn't explain everything that's going on here, but it's just one step. I want to show you, because here you can see commercial industrial lending in blue. Look at how when it decelerates, or even worse, contracts, and that's when dollars are being destroyed, you tend to see the nominal broad dollar index in red, it starts to rally. Now, this doesn't happen every time, but it happens frequently. So the risk we're facing right now is lending is in contraction, dollars are being destroyed, and at the same time, the financial system around the world is short the dollar to the tune of trillions. So what we're seeing right now is the beginning stages of the financial system start to grasp for dollars, before it completely runs out of breath. But it's not just the banks that are starving for dollars. As you're about to see, consumers are too. As job searches for holiday season soar with full-time roles going scarce, think of this. The searches for holiday work are up 27% over last year, up 50% from 2023. So you can see consumers, they need dollars. They're running short. And this is, again, a sign of worker distress, because what we're seeing is a rising share of people holding multiple jobs, now at 5.4% of all those who were employed in August. And when the share tops 5%, it starts to get into concerning territory. So adding to stress for consumers who are looking for part-time holiday work, retailers said, look, we expect to add the fewest jobs since 2009. We're expecting less than 500,000. And if the economy continues to weaken, that number is going to drop in a big way. And I think hours worked are going to get crushed. And I want you to see the effects this has on the dollar. Let's take a look at this next chart of average weekly hours of production of non-supervisory employees in blue against the nominal broad US dollar index still shown in red. Let's build on the last chart, because what happens as consumers run short on dollars, because what happens, their weekly hours are in decline, you see the dollar tends to rise. Now, it didn't happen that way in 2015 to 2016, but hours weren't going up, and at the same time inflation was, so consumers were starved for money. The risk we're facing right now is, as the economy slows, we're likely to see hours get cut, and that's, again, setting the dollar up for a big move higher. Now, on top of that, the New York Fed Regional Services Survey just crashed by the most since 2021. It decreased 4.2 points to minus 23.6. That's a severe contraction. But here's the big issue. A measure of employment contracted for the second straight month, and views on the business climate continue to deteriorate. So what we're hearing from consumers now is they've been telling us they're going to cut back on their holiday spending, and we're seeing evidence that is now happening. So you think about this from the labor market. As consumers spend less, that means those who do have a job, they're going to see their hours get cut, and if things get bad, we're going to see even more layoffs here. Let's take a look at some evidence. Let's look at advanced retail sales versus average weekly hours of production of non-supervisory employees. You can see very clearly, as weekly hours still shown in blue declines, you see retail sales in red roll over and falls right with it. So what we're hearing from consumers is the big reason they're cutting back is because they know the economy is weakening. They're seeing in real time. New orders aren't keeping pace. Backlogs are getting worked through. Export orders are on the decline. And what that means, fewer hours, less money. And one of the other problems we're seeing right now is we're facing a period where imports are likely to come crashing down, as LA port imports fell again in September, despite the busiest third quarter ever. And right now, import volumes in January are projected to be 16% lower than the same month in 2025. And again, you talk about the impacts this is going to have on the labor market and why all of a sudden workers are scrambling for holiday work, looking for a second job, because it's very clear. Let's take a look at this next chart of average weekly hours of production of non-supervisory employees, still shown in blue against imports of goods and services, that in red on a year-over-year rate of change. And you can see as imports go down, what happens? Weekly hours decline. And we see that through every cycle where imports are falling, and we already know that imports are going to contract, and that is a problem because it means the demand for labor is going to go right along with it. And so you put this all together in the midst of a dollar shortage, and you can see why things are going to get a whole lot worse. And despite all of this, as we turn to the Fed, we now hear today from Waller. He says he wants to be cautious, if you can believe that. You don't want to make a mistake, he said, so the way to avoid this is to go cautiously or carefully. And to do that, you do a 25 basis point and wait to see what happens. And then you can get a better idea of what to do. Well, what he doesn't realize is the economy is weakening. He was concerned about the labor market, but now he wants to be cautious. And this is an issue because as you see the banking system run on liquidity, inflation is not going to be an issue here. The risk we're facing is quantitative tightening is likely to end maybe at the October meeting. And that means instead of one rate cut and being cautious, Waller, we're going to see a whole lot of rate cuts, and you're going to be voting for them. In fact, if things get even worse, you're probably going to vote for QE to come back, because you think about it, if the banks are short on money, what's the only tool you have to inject liquidity? It's called quantitative easing. And so now you're seeing why all of a sudden Treasury Secretary Bissett, he's backing off a little bit because he wants to extend the negotiations with China. As U.S. Treasury Secretary Scott Bessent dangled the possibility of extending a pause of import duties on Chinese goods for longer than 3 months if China halts its plans for strict new export controls on rare earth elements. It's very simple. He's worried that the trade war is having real effects on the economy. And the problem is, as you can see, it is. And if we go to 130% tariffs against China in November, what we're facing now is mutually assured economic destruction. It's going to send the dollar soaring as everyone races for cash, and it's going to obliterate the U.S. financial system. Now, when everyone is racing for liquidity, don't worry, I've got a way that you can ride this wave higher and cash in big. Because you're seeing right now this dollar shortage is starting to choke on everything from the banks to holiday spending to the services sector, and even going to impact the labor market. But here's the thing, you're not powerless, you can act now. You need to diversify into hard assets. Slash your debt if you can. You got to bulletproof the cash flow that you do have. And hoard liquidity like it's gold. Because here's the thing, when this whole thing does blow up, you're going to see right now it is going to be worth more than gold because the banks are telling you that it is. Now, knowledge like this, well, it's your unfair edge in the meltdown to prospering and creating wealth. And something else we think can create a lot of wealth, well, that is the stock for our sponsor for today's show. It's the House of Doge. Again, you can find them on the NASDAQ under the symbol TBH. Everything you need to know in the pinned comment and description below. Let's take a look because the House of Doge is a business muscle of the Dogecoin Foundation, flipping that level meme coin into a financial superstar. This merger with Bragg Holdings, the ticket to NASDAQ glory, blending crypto smarts with gaming and sports hype to supercharge Dogecoin's everyday wins. The ride's just holding up. Let's go. And fresh off the press this week, the board's greenlit a reverse takeover where Bragg scoops up House of Doge, paving the way for a public splash early next year. It's all about teaming Dogecoin's massive community with Bragg's Gen Z crew, who pack over $350 billion in spending power. Picture payments at sport events and college hangs going full Doge. Revenue streams are going to light up like fireworks. And fueling the fire, well, it's killer ties like 21 Shares Dogecoin Fund crushing $26 million in assets, Robinhood cooking up yield goodies, and Clean Course Treasury stacking over 730 million Doge tokens. And add in U.S. ETF filings under SEC watch, and that's the door swinging wide for a fresh cash flows and global grabs, turning Dogecoin into a yield machine that everybody wants a piece of. The merger magic, well, it kicked off with a big share splash of about 594 million new ones to lock in House of Doge as top boss, sparking an early dip as the market chewed it over. But we're seeing dip buyers step in because with 50 million in smart backing and fair value thumbs up from the pros, the sub screams setup for a massive comeback rally. And at the wheel of the helm is Marco Margiotta. He slides in as CEO fresh off scaling payment empires with 6 board seats for House of Doge firepower. And Laval Blamoy sticks around to keep gaming pulse pounding. And hot off today, the new chief digital officer Matt Swan joins to amp up the tech edge. And these moves, well, they're pure rocket boosters for scaling payments, token tricks, and community blasts that pump enterprise value sky high. And this just isn't a listing, it's a launch pad for the diversified bucks from Dogecoin merchant deals, data gold mines, and treasury plays holding 837 million tokens strong. And merging with Bragg unlocks Gen Z activations in sports and retail, where Dogecoin flows easily. As institutional eyes lock in, expect earnings to surge with regulated products and yield wins that make the whole ecosystem pop. Let's take a look at the stock chart here, because you can see after that big gap down on the news, well, what you've seen is buyers step in each and every day. They're holding that 100-day moving average. They're coming right up on that 6-month volume profile. And you can see that at close of that, there's not a lot of volume setting up for a massive move higher. So keep an eye on the House of Doge. You can find them on the web at houseofdoge.com and on the NASDAQ and the symbol TBF, because right now with the House of Doge, the sky is the limit. And as always with any company we feature on the show, you're under no obligation to purchase their stock. Be sure to research before placing any trades and use your risk control levels when you do. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.